China's economic engine is sputtering with a mix of highs and lows in October, leaving experts and investors on edge amid the looming uncertainty from the upcoming summit between the US and Chinese presidents. It's a pivotal moment that could redefine global trade dynamics. But stick around, because this isn't just another set of dry numbers. It's a window into the heart of one of the world's largest economies, and the twists ahead might just surprise you. Let's dive into the details. Fixed asset investment. Think of this as the backbone of economic growth, encompassing everything from factories and infrastructure to new buildings, took a noticeable dip, falling by 1.7% year-on-year. That's a widening decline compared to the 0.5% drop seen in the first 9 months, and it even undershot the expectations from financial data provider Wind, which had predicted a milder 0.71% decrease. For beginners, fixed asset investment is crucial because it signals how much money is being poured into long-term projects that drive jobs and innovation. A slowdown like this could mean companies are holding back due to caution or tighter finances. On a brighter note, retail sales, which track how much consumers are spending on goods and services, showed some resilience. They grew by 2.9% year-on-year in October, beating Wind's forecast of 2.73% and only slightly trailing September's 3% uptick. This indicator is a big deal as it reflects consumer confidence and everyday economic vitality. Imagine it as the pulse of the middle class, with more spending meaning healthier wallets and happier households. However, the 8-day Super Golden Week holiday, a major shopping bonanza in China, saw retail and catering sales rise just 2.7% year-on-year, a far cry from the robust 4.5% growth in the same period last year. It's a subtle but telling sign that while people are still buying, the enthusiasm isn't as fevered as before, perhaps due to economic pressures or shifting habits. Industrial output, measuring the production from factories and manufacturing sectors, climbed by 4.9% in October, though this was a slowdown from September's 6.5% expansion and fell short of Wind's 5.52% estimate. To put it simply, this gauges how efficiently China is churning out goods, from cars to electronics, which are vital for exports and domestic supply. A gentler rise might indicate supply chain adjustments or global demand fluctuations, reminding us that even in a powerhouse like China, no sector is immune to broader market ripples. And this is the part most people miss, or perhaps the one that sparks the most debate. The struggling property sector continues to cast a long shadow over the entire economy. Real estate investment plummeted 14.7% year-on-year in the first 10 months, worsening from the 13.9% drop in the first 9 months, as per data from the National Bureau of Statistics. For context, China's real estate market is enormous, influencing everything from bank loans to urban development. A slump here can ripple out, affecting jobs, consumer spending, and even government policies. But here's where it gets controversial. Some analysts argue that this downturn is a necessary correction after years of overbuilding, potentially leading to a healthier, more sustainable market in the long run. Others warn it's a symptom of deeper structural issues, like demographic shifts or regulatory changes that could hinder growth for years. Is this a temporary hiccup, or the beginning of a major economic overhaul? Do you think international tensions are exacerbating the problem, or could they actually force positive reforms? What do you make of these mixed signals? Does the slight uptick in retail sales signal hope for a rebound, or is the property sector's decline a red flag for global investors? Share your perspectives in the comments. Agreement, disagreement, or fresh insights are all welcome.